China has launched a bold new challenge in its ongoing rivalry with the United States, with the US dollar at the heart of the latest battleground. The Chinese government is actively betting against the American currency in hopes of seeing its value fall. To achieve this, Chinese banks have been heavily involved, dedicating more than $100 billion to this cause. These banks are effectively gambling that the dollar will decline, which would generate significant profits for them. In financial terms, this maneuver is known as shorting. Let me break this down with an example. Imagine a small Chinese bank has 500 yuan in its coffers. The bank then decides to place a bet against the US dollar, so it goes to an American bank and agrees on a deal. The Chinese bank lends its 500 yuan to the American bank and in return, borrows the equivalent amount in US dollars. At the current exchange rate, 500 yuan is worth about $70. Now the Chinese bank holds $70 US dollars, while the American bank holds the 500 yuan. This is essentially a loan, and both banks agree to revisit the deal 1 year later. During that year, the value of the dollar could rise or fall. If it falls, the American bank would need to repay more yuan to the Chinese bank to reclaim its $70. When the two banks meet again, the Chinese bank checks the new exchange rate, and if the dollar has lost value, the American bank must repay more than 500 yuan to get back the $70. This is how shorting works. Banks and investors use similar strategies in stock markets to profit from declining values. For over a year, Chinese banks have been engaging in large-scale foreign exchange swaps, an instrument used for shorting currencies, and these transactions have exceeded $100 billion. But why is China doing this? Is this a form of currency warfare? Not quite. It's more of a defensive strategy, with China's central bank leading the effort. The primary goal is to support the value of the yuan. When a bank takes a short position and swaps the yuan for the dollar, fewer yuan are left circulating in the market. As the yuan becomes scarcer, its value rises because scarce commodities typically fetch higher prices. This move was designed to bolster the yuan, which has been struggling in recent months. The Chinese currency dropped to a 7-month low against the US dollar in June, triggered by two main factors: a strengthening US dollar and a weakening Chinese economy. Investors have withdrawn billions from Chinese markets this year, adding further pressure to the yuan. Instead of addressing the root economic problems, China has opted for a shortcut, attempting to bring down the dollar to strengthen its own currency. However, this strategy carries risks. If the US dollar continues to rise, Chinese banks could face severe losses. Already, some estimates suggest that Chinese banks have lost between $5 billion and $16 billion in this gamble, but Beijing seems undeterred. In fact, it is preparing for another challenge by strengthening its financial sector. A major step in this direction is the merger of two state-backed Chinese brokerages, which will create a $230 billion financial giant. While the deal still requires shareholder approval, it is widely expected to go through without issue. This consolidation is part of a broader strategy ordered by Chinese President Jinping. His vision includes developing world-class investment banks and creating a financial sector that can compete with Wall Street. This ambition represents a dramatic shift from a few years ago, when the economies of China and the US were deeply intertwined. American companies were pouring billions of dollars into Chinese markets, while Chinese companies were listing on US stock exchanges. By 2019, over 150 Chinese firms had gone public in the US, collectively valued at more than $1 trillion. But this era of cooperation now seems to be ending. In recent years, the US has ramped up trade barriers against Chinese goods and encouraged American companies to reduce their dependence on Chinese factories by reshoring their supply chains. At the same time, Jinping has launched a campaign to challenge the US-led global order. The divide between the two superpowers is growing deeper, and China's financial maneuvers are just one front in this broader geopolitical struggle. By targeting Wall Street, China is signaling its desire to reshape the global financial landscape. The merger of its state-backed brokerages is part of a long-term strategy to build financial institutions that can rival those in the West. This is no small task, considering Wall Street's dominance, but China seems determined to mount this challenge. The outcome of this financial conflict is uncertain. If China's bet against the US dollar pays off, it could significantly boost the value of the yuan and help stabilize its economy. But if the dollar remains strong, Chinese banks could suffer even more significant losses. Nonetheless, Beijing is doubling down on its efforts, convinced that this strategy will pay off in the long run. Analysts said Mr. Dai Bingguo's comments at the G20 meeting, calling for the diversification of the reserve currency system, reflect China's broader strategy to reduce reliance on the US dollar. The United States, aware of China's financial strategies and its increasing efforts to challenge the dominance of the US dollar, has responded with a series of threats aimed at cutting off Chinese banks from access to the American financial system. This escalation could have severe consequences for China, as it relies heavily on the US dollar for trade and investment purposes, as do most countries across the globe. The threat to sever China's access to dollars is not just an economic maneuver, but a strategic move in the larger geopolitical rivalry between the two nations. The US dollar remains the global reserve currency, and its dominance allows American financial institutions to control a large part of international transactions. By cutting off Chinese banks from access to dollars, the US would essentially be isolating China from this global network, putting significant pressure on its economy. Without access to dollars, Chinese banks would struggle to settle international trades, and companies dependent on these banks would face significant setbacks. This potential move comes at a time when tensions between the two countries are running high, particularly over trade and technology issues. The US has imposed several rounds of tariffs on Chinese goods, and the trade war has only intensified over the years. Additionally, Washington has also placed restrictions on Chinese companies such as Yuan, accusing them of espionage and violating international norms. Cutting off Chinese banks from the dollar would be another major blow in this ongoing economic confrontation. For China, this threat presents a serious risk. The country is the world's largest exporter, and its economy relies heavily on international trade, most of which is conducted in US dollars. Chinese companies and banks depend on access to the dollar to pay for imports, finance global investments, and settle transactions. Without this access, China's financial institutions could be paralyzed, and its economy could suffer a significant downturn. Moreover, such a move would not only affect China, but could also have repercussions across the global economy. Many nations rely on trade with China, and cutting off Chinese banks from the US financial system could disrupt supply chains, causing widespread economic instability. It could also lead to a backlash from global markets, further escalating the situation and causing uncertainty in the international financial system. As China ramps up its financial challenge against the US dollar, the stakes are higher than ever in this global economic showdown. Will China's bold bets pay off, or will the risks lead to greater losses? Let us hear your thoughts in the comment section. Thanks for watching, and don't forget to like, subscribe, and hit the bell icon for more insights on the world's most pressing political and economic battles. See you in the next video.